Well, hi there, everyone, and welcome to the VIP Trade Room with Roger Scott and Matt Horton. Now, today is Wednesday, February 25th, and my name is Raleigh White, and I'm coming to you live from a beautiful sunny day here in Austin, Texas, and I'm going to be your moderator today. Now, in today's session, Roger is going to be covering a range of important topics with a continued focus on options and how he likes to trade them. Now, we're going to begin by doing a midday market analysis and an updated stock watch list, and then we're going to pivot. Yesterday, we started talking about credit spreads, and we want to basically summarize that discussion and how we like to trade them. And then we want to move into an introduction on diagonal spreads and when we like to use them. We'll talk about what market environment is best for a diagonal spread, how diagonal spreads work, and what strikes to use, and then the best way to manage a diagonal spread to maximize your gain. So we have a huge session today, continuing masterclass on how to use options to trade the markets. Now, if you've got any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout Roger's presentation. And remember, folks, that I have opened the chat to everyone, and we do have some ground rules. Always be kind and supportive in your post. Please keep to the topic. No political discussions allowed whatsoever, and keep that chit chat between one or two members to a bare minimum, because this is not a general chat room. This is an area where we've come to listen and learn from the education and information that Roger's sharing, because he's here to give us an edge and to help us all become much more confident and consistent in our trading activities. Now, if you were with us this morning at 8 o'clock for Roger's pre-market briefing, you'll note that there were several key catalysts that we needed to be aware of today. On the tech front, we noted that Oracle was coming into the open up 2%, but that Workday was down 8% coming into the open. On the consumer front, we noted that PSKY was up 2%, with Lowe's and TJ Maxx getting ready to release their earnings before market open. On the aerospace front, Axon was up a whopping 16% coming into the open. And with energy, we noted that First Solar, FSLR, was down 17% coming into the open. On the international front, we noted that the Euro stocks were up 0.7% and the Nikkei was up 2.2%. That's all-time highs for the Euro stocks and for the Nikkei. And the Shanghai markets, which just opened up this week after a week's vacation, was up 0.7%. So we definitely had some tailwinds coming into our open from the international markets. And then on the Fed front, we noted that there was just a couple of things to be aware of. We had crude oil inventories that are scheduled to be released this morning, and then we have three FOMC speakers scheduled to speak throughout the day. Now, a lot of people are wondering the question, Raleigh, what are these catalysts? Why share them? What do I do with them? What do they mean? Well, from Roger's perspective, he believes that information that is either known or will become known during today's trading session represents, but is not yet priced into the market. This represents volatility flashpoints that we definitely need to be aware of. And so, from that perspective, holistically, we like to know what's going on. I also want to point out that when we mention a stock like Axon, for example, or First Solar, we're only looking at S&P 500 stocks that have shown at least a 1% move in either direction. So that's our focus. We know that there are a lot more stocks that are releasing earnings, but the one that we're focused on is anytime an S&P 500 stocks is getting ready to release earnings. Now, as far as Roger's pre-market stock watch list is concerned, today he gave us 20 tickers to keep our eyes on. There were 8 shorts and there were 12 long tickers. Now, if you're with us in the morning, you know that when Roger brings up a stock like ADP, for example, he brings up the chart and he gives us a real quick analysis as to what he sees and what he's looking for. And he does that on each one of these tickers, to the short side and to the long side. Now, these are on a watch list, which doesn't mean these are stocks that you should automatically trade. But from Roger's perspective, he says they are setting up. They're not ready for prime time, but they look like they're setting up for a move. And if any of these tickers, for example, meet his criteria, meet his filter for what he's looking for, then more than likely he'll be taking that trade and sharing that trade in the trading pit and in the other premium alert services that he provides. As far as Roger's pre-market thoughts are concerned, we did note that the futures markets were all moving higher into the open across the board. That was the S&P 500, the Nasdaq, and the Dow. We also noted that the put call ratio was in balance and the VIX was moving lower. It dropped below the 20 level from yesterday and was lower right at the 18 level. And Roger's hoping it continues to drop because that will give the market some upside momentum. We also noted that the bonds, the SPY, the QQQ, the MAGs, the Russell, the chips were all up nicely, with SMH in particularly being the star, but everything was moving up nicely. We also noted that the sector rotation continues to move towards spec stocks, and that rotation basically started last week as defensive stocks were occupying the top positions, and now they're slowly being replaced by those speculative stocks. And you know what Roger feels about that. He wants to see those spec stocks in the top position to further give us momentum in the market. Talking about momentum, we noted that the companies that are setting 20-day and 90-day highs are significantly outpacing those that are setting 20 and 90-day lows. So we really do have a nice momentum in the market. Bottom line, folks, Roger really likes what he sees this morning, but there are a couple of caveats. As attractive as things are, we have to remember that NVIDIA is posting results this evening. So avoid the temptation to go crazy. Avoid the temptation to pile in particularly in the chip stocks and the tech stocks. Let's wait and see until what happens with NVIDIA and how the market responds. And I think that was pretty sage advice. So, folks, once again, we have a great agenda on tap for us today. This is a continuing focus on how Roger likes to trade options. And in today's class, we're going to focus specifically on diagonal spreads. We're going to begin the session with a midday market analysis and what Roger's updated stock watch list is for the balance of the afternoon. Then we're going to pivot. He's going to summarize yesterday's discussion on credit spreads and how and when to trade them. And then he's going to introduce diagonal spreads and when to use those. He's going to be talking about what environment is the best for diagonal spreads. He's then going to talk about how diagonal spreads work and what strikes to use, and then the best way to manage your positions for maximum gain. So this is going to be a mini masterclass on diagonal spreads, and is part of Roger's continuing education series on how he likes to use options to trade the markets. Now, if you've got any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout the session so as to not interfere with Roger's presentation. And remember, folks, that we have opened up the chat window to everyone, and we do have some ground rules. Always be kind and supportive, okay, in your posts. Number two, please keep to the topic. Number three, no political discussions allowed here whatsoever. Number four, please, guys, keep your chit chat between individuals to a bare minimum. It just interferes with the rest of us that are trying to focus on what Roger's talking about, because after all, he's sharing information and education that's designed to give us an edge in the markets and to help us all become much more confident and consistent in our trading activities. And with that, folks, let's say hi to the folks in the room. We've got Matt here. We've got Roger here. I noticed, Matt, you've been particularly busy today. You've got a couple of trades there in Trading Zone Live. Both of those winners. You're up about 1.5 points so far. So, man, you continue to be a hot commodity. You are on fire.
We are doing really well. I just posted in there, we hit 8x return on our one contract.
Oh, on our portfolio? Okay. Yep. 8x returns. Way to go, Matt. That's outstanding. Yep. Roger, always great to see you, my friend. Once again, interesting day today. Good session this morning. I know you liked what you saw. So many things are just moving in our direction. And you know what? Yeah. the markets are, and they're on board. I mean, I'm looking at the SPY and the QQQ intraday, and I'm looking at TLT, and they're all tied at the hip. They're all moving up together. Somebody
Yeah.
got the
Yeah.
invitation and the memo.
Yeah, definitely. There's definitely something going on right now. There's a lot of movement right now. And I like the indices. As a matter of fact, let me go ahead and share my screen. By the way, folks, did you get your SMS and email alerts? I know the Telegram alerts came out. I just want to make sure you guys are getting your emails. Let me just go ahead and open up the chat for a quick second here. Okay, Elsa, did you get your email or text or
Are you talking about alerts or invitations to
no
join us?
invitations to come to the room?
Oh, okay. Yep.
Invitations to come to the
Yep.
room. No email. Okay. Do you usually get emails, David?
Yeah. Dieter says he's getting all of them.
You,
Email, yes,
you
from Mary. Yep.
you got the email, Mary? So you got the email. Okay. Okay. Good. That's what I wanted to make sure. Okay. Okay. Cool. That's what I wanted to make sure. The reason I'm asking is because we had someone new start taking over this job, and I wanted to make sure everything's going out the first week, to make sure everything's kosher, and just wanted to make sure. That's all. Thank you for letting me know. Okay. Cool. Thank you. Thank you. Thank you. All right. So let's just kind of review a little bit, real quick. Good afternoon, everybody. Good afternoon, everybody. Sorry, I don't mean to change the topic. I just wanted to make sure everybody got everything. So the SPY is well above the 8-day EMA, which is right here. This is the most beautiful thing I've seen in a very long time. This is nice. This is very nice. We consolidated here, and now we're going higher. And if you look at mags, now obviously we're not up here yet, but we're starting to get into the 15-day. We need to get up here, and I'm hoping NVIDIA has something to do with it. But we need to get higher up. Okay. So far, we're doing really good. We were right at the 8-day. Now we're at the 15. We're starting to see a little trend. It's easier to see stocks trending today, obviously. When stocks are just sitting like this, it's like watching paint dry. Okay. So thank you, Peggy. I appreciate that. Okay. So mags are starting to move. QQQ obviously starting to move. We have some levels here, which we really don't need to. Here, let me erase all this. Yeah, we don't need these. This is really important on the QQQ. Why? Because this is the 50 and this is the 100-day. And if we can, you see how they're starting to move up. This whole consolidation is moving higher. This is very, 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 very positive. And I'm hoping that tomorrow we will see the QQQ appear. SMH is already making new highs, which is fantastic. So I'm not seeing. I know that a lot of
Roger, are those record levels on the SMH?
yes. Oh
Yeah,
yeah,
record
yeah.
highs. Yep.
All-time highs. All-time highs.
Wow.
Europe, Japan, and Europe went up overnight very, very nicely, all-time highs. So we're not looking all that bad. RSP is still consolidating here. I'm not seeing anything that bad or terrible or anything like that. Matter of fact, I really like what I'm seeing. Now, let me just check something. I want to check volatility. I haven't checked it since this morning. I've been really busy doing some time-wasted stuff that I shouldn't have had to do, but it doesn't matter. Right here. This is what I was waiting for. And I hate to say I told you so, but remember this morning? I told you guys that I'm looking for a breakdown here.
Mm-hmm.
I'm looking for this to break down and come down to this level. I had this template on, cleaner template right here. But I drew this for you right here.
Yep.
Here's that line. And if not this one, if I don't really need this thing, this one is what I'm talking about. If I extend this just a little bit higher up, you could see we're getting close to this area. Pretty close to that area. Real close to that area. That's really nice. That's what I want to. This is what I want to see. Okay. This is exactly what I want to see. Okay. Over time. All right. All right. So things are. I mean, let's look at financials real quick. I'm so used to being so critical of everything, Raleigh, and so negative but there's nothing negative. The financials are bouncing back nicely. Let's see how Nvidia's doing, just out of curiosity. Again, I'm always looking to talk smack, but there's nothing bad. And by the way, I always tell you guys this: the longer something consolidates, the better the move. That's a move right there. We haven't been up here in Nvidia since 1120. Now look how it looks on a weekly basis. See, that's an A line on a weekly basis. A long-term consolidation and a breakout, that's an A line. But on a weekly basis, those are fundamental moves. So Nvidia theoretically can come up all the way back up. So again, just wanted to show you guys, that things are not looking bad. Now, I don't know what Nvidia is going to come up with. And more importantly, I don't know how people are going to react on Nvidia. That's two different issues, okay? But I will tell you this, I really like how things are looking right now. And I wanted to show you something else that's interesting. Now, this is something you should pay attention to. This is the sectors, and you could see a few days ago, I was talking to Richie. We were talking, and he was like, a lot of these consumer staple stocks are going up, and they were going up, and they look great. But I made a comment that if technology starts moving up again, these stocks are toast, and they are. So one of the things you don't want to be in a position or in a sector that's completely dependent on something else. So these consumer stocks, they started going up as soon as technology started to falter. So my point here is always step back and see why something is happening and why it's moving at the speed of light. Cigarette stocks, consumer stocks, defensive stocks. But again, technology and financials are starting to move again. These are the most speculative sectors, okay? So to me, this looks like a move that the technology, not financials, a move that is going to begin occurring again. And you can see we never really dropped off too much. What's good, what I really like about this is that we have quite a while to go. And even on QQQ, we still have a while to go. So if we start running, we could really see a run, really see a run up, okay? Again, I don't know what will happen. We'll have to see. But folks, don't go crazy, because just when you think you know, the rug will be pulled under you. We don't know. Nobody can predict the future. We can't predict. Even if Nvidia says our revenue is amazing, we don't know how the Wall Street will react to it. So you've got to be able to predict the earnings, and you have to be able to predict the reaction from the earnings, and you have to overcome implied volatility. That's a lot to get right to make money in Nvidia in the next 24 hours. Just saying. All right, so I wanted to show you I like everything. I like. I'm probably going to get beheaded because I'm saying all this nice stuff, but I do like how the upside is looking. It's looking really good. Now, let me give you stocks that I'm focused on right now, and then I'll give you and then I'm going to do a Master Blaster disaster class in diagonal spreads, which and by the way, the QQQ looks like it wants to break out. Are you long, Matt?
I'm actually short.
When did you go short?
Right at the top. We're short from 692.18.
So you took a profit and
we
went
took
short.
A profit, and then we waited a little bit, and then we went short when it looked like we were topping out.
Because we're in lunchtime right now.
And the Vold's kind of...
Vold is coming off, yeah. Yeah, Vold is kind of consolidating, and ADD's not really going up. Yeah, that kind of makes sense. And it's lunchtime.
And we know if we're wrong, right? If we break the high, then
we're
out 20 cents.
I would say the VWAP would be a good target here.
Oh, yeah.
Yeah, about 691.15. So here's what Matt and I are talking about. So you guys could see. We're talking about he got in right here. If it breaks the high, we're out. And the profit target would be right here. So your risk to reward would be from here. Your risk to reward would be from here to here. And your profit would be from here to here. Potentially.
That's a nice ratio.
Yeah. Sorry, HG. Here, you could look at my Vold if it makes you feel better. And that's a trading view issue. It's not even trading view, it's their data provider. You guys can switch to another data provider. Just FYI. Right here. That's the Volt right now. So it went down. Now it's going up. Now it's choppy, which means it's not all that bad. Still pretty strong, but it's not trending. It's not trending. It's choppy. I'd be careful here, but that is a good risk to reward trade, and we are in lunchtime right now. And lunchtime we tend to sag. Just don't give this one too much room, Matt. Okay. All right. All right. All right. Now, with that said, let me give you stocks. We got so many. Raleigh, we took a trade after the room here. Not after the room, before the room. We took a trade in PayPal yesterday, and PayPal
Yes. Yep.
hit hard after with the news that XYZ wants to take over, that Block wants to take over. What's interesting, what's really interesting is I got 150 something emails. I still kept getting emails this morning. People kept it overnight. Here it was. Let me see what it's doing right now. Yeah, it's still at the same price. You could still get out, but I got a lot of emails. It made a lot of people very happy. That was a gap to green trade, by the way.
Mm-hmm.
Okay, so let me show you stocks that I'm currently very much in love with. SE, beautiful chart, beautiful pattern, very nice stock, very, very attractive. Yeah. Sorry about that. I got to check one more stock. Got to add this to our watch list. Fresh off the boat. Okay. Look at that, David, 72% on PayPal. Great. Okay, I'm going to close the chat and let's look at our stocks. So you got SE right here. All right, SE right here. You got LVS breaking the 200-day moving average, folks. Not good. Not good. I mean, good for us for the short side, but not good for the stock. And there's that shoe. There's that boot, and here's that shoe we're always talking. We're seeing the same pattern.
Yes, we are.
It's the shoe breaking the shoe's breaking the 200-day moving average. Must be a smelly shoe. All right, STSH. Oh. Nice breakdown. Notice, look to the left. There's nothing here. There's nobody propping this thing up. Look at the trend. Look how it just goes down to 8-day EMA. It's very nice. And volume, by the way, is getting a little higher here. I like the stock so much, I put it twice on my list, HPK. That's a nice stock, SC, by the way. Very nice stock. GPK. Nice stock. Volume is not there. That's the only problem. But it's holding on to that 8-day. It's a cheap stock, too, $11. Now, remember, I don't have a problem with cheap stocks as long as they were expensive stocks at one point. So if at one point a stock was 30 and now it's 10 on the way down, that's great. That just makes me want to sell it even more. What I don't like is stocks that were $11 and are still $11 or went up to 13 and now that I don't like. So the stock must have been at some point over $20. This only applies to the short side, okay? That just makes me like it even more, the fact that it was over 30. Because and I'll explain to you why. A lot of people don't understand the let me explain to you the rationale behind it, because I don't want to leave you guys too little information can be dangerous. There are several brands of institutions, okay? There's several brands of institutions that will only buy stocks that are trading over a certain price. And if a stock is not trading over $20, they just dump it automatically. So that's why we want to only buy stocks that are over $20. That's Wix. I've had this on my list for a while. Look at that trend. I gave it to you right here, right there, right here, right here, right there, right there, right there, and I'm giving it again. W, below the 200-day moving average. Not much support here. Don't see many high volume candles here. Yeah, it's a pretty good move here. Wayfair. And remember, this is they sell furniture online, which by the way, this is an awful company. I pray to God you guys don't use this company. I bought some stuff from them when I was moving to Florida 8 years ago, and we unpacked it uh, after we came here, which was like later than their 30 days, and half the things were cracked and just off. I mean, it was don't buy. And then I read a report that they have a tendency to ship people things that they shipped to other people that were broken before. So I would stay away from them. Had a very bad experience with them. BMY. This stock looks very similar to Johnson and Johnson. Looks like it's making friends with the 8-day EMA right here. It's very similar to Johnson and Johnson. And here's Johnson and Johnson. You could see it right there. All right, BMY is the first one. BE. This would be more of a day trading stock. I mean, you could still engage if on a pullback, but not directly. LRCX, chip stock, not today. Not today. Not today. Don't even think about it. Unless you're a big time gambler. Oh, BRT. That's a nice look right there. That's a really nice look right there. MNST. MNST. That's really nice stuff. That's a beauty right there. Nice grinder right there. Wouldn't mind buying this one off the 8-day. Let me put an alert on the VWAP for this one. Oh, earnings. Earnings. No soup for us here. Earnings. I knew it was too good to be true. Teradyne, another beautiful chip stock. I mean, beautiful chip stock. Would I engage today with this stock? Absolutely not. No way. Hold on, I gotta take this off here. Okay, sorry about that. Okay. Not today, not before NVIDIA earnings, not unless I had a death wish. Dollar General. Richie actually was talking about this stock the other day. Beautiful stock. I'm actually long right now, Dollar Tree, which isn't looking good at all. But DG still looks good. And it's kind of funny. They usually move together. SCCO, another chip stock. No, not a chip stock. Copper stock. Sorry, copper stock. Very nice copper stock. Okay, copper stock. Very nice. By the way, this is a Russell 2000 stock. We were talking this morning about Russell 2000, about how the stocks in the Russell 2000, they move. The smaller stocks, the smaller the stock, the bigger the move. This stock can really move, and it's a Russell 2000 stocks. Okay. Ross Store, beautiful stock, beautiful grinder. Love this. Now, stocks like this, you should be buying them around the 8-day EMA. Kind of like what I did with Johnson and Johnson today. Okay. Okay. Alcoa, another one. That is a very nice looking stock. I am going to put a VWAP alert on this one. Okay. All right. That is my watch list. Now, I am going to show you guys something really cool right now.
Hey, Roger.
Yes.
Yeah,
Yes.
before you go
Yes,
there,
sir.
I want to address a question that came up from Sharon.
Yes.
And I
Yes.
think others might be in the same position. So this is her first time in the room. And she's going like, are we supposed to know what to do with the tickers he's listing? And where do I go to learn what he is assuming that we know? So once again, first time coming here into the room, Roger, I know we have a lot of first timers that come in here, and that's the kind of question they ask. So how do we want to address that?
Well, first of all, there are several places. One place is I have a 12, I think I have a 12-week VIP uh, uh, program where I summarize 12 weeks of classes into a video sessions. And I think you can get those in the VIP room. That's one. The boot camp. Thank you, Ken. The boot camp. Number two, Customer Service Live, the Cam and Gustavo show. Great place to start and ask these questions. Number three, and Sharon, I tell this to everybody. If you start coming here every day, even if you know absolutely nothing, you will find that coming here will be like watching a soap opera. Um, you will start getting used to the language and the terminology because you will find that what we talk about is very limited. Now, let me explain something. How the market, so, and I want to explain this to you very, very simply. If you look at the Constitution, and I'm not talking about politics. I'm trying to give you an analogy, okay? Don't get all political on me here. But if you look at the Constitution, it's very small. It's a very, very small document, right? But if you go to law school, con law is one of the biggest classes in law school. It is. It's a full year class or a full semester class, depending if you're part time or full time. And the book is like this thick. So you ask yourself, well, how come the you know if the why is learning constitutional law take a year if the damn thing is only this small and written 300 years ago, right? Well, the reason is because the rules are not the key. It's the scenarios. It's the scenarios. And coming here is exactly the same way. I can give you my playbook in 20 minutes. Learning how to apply it to a million different scenarios is what takes years and years and years. The beautiful part is if you keep coming here every day, that playbook will be, you will know that playbook. So you will be able to understand what we're talking about. And at that point, it'll be just like putting it in a different context. To give you a good analogy, imagine you're watching a soap opera, your favorite show, and you miss an episode, okay? And you miss an episode and you turn it on. How long would it take you to figure out what's going on? A few minutes at best. You'll probably figure it out before they start talking. You'll be like, okay, that's what I meant. That's how I operate. So while what I'm talking about may sound really new and abstract to you, if you've been coming here every day, most people here can tell you what my next word is going to be. I'm extremely predictable. I do exactly the same thing every single day. I teach the same way. I analyze the markets the same way. The only thing that changes is the market, the scenario. Okay. So if you can come here for, say, 30 days, you will understand so much more about the market than you ever thought you did before. And most importantly, you will start learning how to apply it. And that's the problem. Learning all this stuff is simple. Learning how to apply it takes lifetime because every scenario is different. Okay. Hopefully I was able to answer that question in
Roger,
an
I think you did a
way.
great job, and that's why I wanted you to address that. And we need to do that periodically. So for the newbies that are here, don't feel intimidated, okay? It will feel like information from a fire hose, or it will feel like you're getting in your car and you're thrown into the left lane. Just sit back and relax and absorb what's being said. And Roger, so many people have already posted here in the chat that when I first came here, I didn't know what was going on. And a few weeks later, it was like normal language for me. Okay. It
Exactly.
is
Exactly.
highly repetitive. And not only should you folks come every day at noon, also come at 8 o'clock in the morning when Roger does his pre market show, because all of his education on the day starts there. And it is also like a soap opera. as the
Yes.
market turns.
Yeah. As a matter of fact, in the morning, I even go further. In the morning, I even show the exact same slides in the exact same order every single day for the last 7 years.
Yeah.
So you will even know what I'm about. I mean, like, okay, like we talk about the sections, different we don't, I mean, I am really like that. I'm very methodical, and that's just how I am. So I can't go A, Z, B, D. I can't do that. I have to start at A, B, C, D, E. So you will learn. You will learn, and you will learn a lot more. And here's what will happen when you try to go to another class after. I'll spoil it for you because you're not going to get the same thing for most others. You'll see, and you'll see why yourself. Okay.
Yeah. Thank
Um,
you, Raj.
yeah. No problem. No problem. That was good. So I'm going to talk about profit anchors, as we call them. Now, it's a fancy name for diagonals. So I want to explain to you guys exactly what it is. And it's something that we started offering in the weekly cash flow beginning of this year, actually maybe even before the beginning of this year. Um, so I'm going to explain to you what it is so you guys can understand it, okay? So we call them profit anchors. They are now part of weekly cash flow. I think we've done 3 or 4 of them since we started. They come up right after earnings, and I'll explain why. Okay, and I can actually even use this chart to show you an example. Yes, and assume you know nothing. I'm going to close the chat, but assume you know nothing. That will really help. If you're one of those people who thinks you know that you know everything about trading, you're going to be really disappointed. But if you're one of those people who says like I'm going to come here with an open mind, you can end up doing really well. All right. So the goal of the strategy is to collect weekly option premium on neutral to slightly bullish stocks setups after earnings. After earnings. Now, the reason we want to do it right after earnings or when a stock had a move or some kind of a movement is because what we're doing is we want to take advantage of the implied volatility, a fat implied volatility in the option premium that are expiring soon because we want to sell those. Okay. So I want to explain this to you. So the idea, so basically we're looking for stocks that are kind of moving like this, kind of like this, or we don't want stocks that are moving like this. Okay. We don't want this. We don't want that. We want something like this, just sideways, a little higher or sideways, not lower, something like this, like Johnson and Johnson, not like right here, maybe this kind of movement right here. But we also want the stock to just have experienced earnings so that the premium in the options are expensive, and you'll understand why in a minute. Okay. So I have another strategy called time spreads. It's a very, very similar strategy. That one we do before earnings, leading into earnings. But this strategy we do right after earnings. So you can start doing time spreads before earnings, and then you can do this one right after earnings. Now, why is this strategy? And by the way, we use puts for this strategy. We use puts. All trades are done in puts. All right. We're looking at puts that are expiring the same week that are really fat with premium. They have a lot of premium, okay? And we want to take advantage of the disparity between implied volatility and time decay over 2 periods of time, okay? 2 periods of time. So we want puts that are expiring the same week, and then we want puts that are on the same stock that are expiring in 2 months. Okay. Now you're probably thinking, well, why would you do that? Shortly after earnings, implied volatility is exaggerated and inflated, which gives us a higher edge and makes it cheaper for us to get into the trade. Now, we don't need to have high implied volatility or earnings to do this. We could do it on any stock. But if we just had earnings, the cost of the option that we're going to be selling will go a long way in bringing in more premium, which means we won't have to hold the trade for as long. Hey, my Alcoa, what happened? Oh, I thought my Alcoa just hit the VWAP. I guess not. Okay. Let's continue. Let's continue. So now I want to explain to you, let me just step back and I want to explain to you what we're trying to accomplish here, okay? Why do people avoid selling naked puts? Okay, can anybody answer that question? Let me open up the chat. Why do people avoid selling naked puts? Assignment? I don't mind getting assigned a naked put. Okay, now we're talking. No, not nobody cares about getting exercise. The risk, unlimited risk. Yes, unlimited risk. Look, let me show you. Let me give you a little trick, guys. Okay, let me show you something. This is Apple, right? I could sell a naked put at 240 and I'll get assigned at 240, which means I'll own Apple shares at 240. It's not that bad. It ain't that bad to own Apple below here. So assignment is not the worst thing. It's the unlimited risk. You sold the option here for $1. When it gets down here, it's worth 100. You just lost $99. You risked $1 and you lost $99. That makes you a really bad trader, right? Okay. So unlimited risk, unlimited risk. Why do people don't like naked puts? Because of the risk. Nobody cares about assignment. Okay. It's because of the risk. The risk. Okay. Exactly, Jeffrey. Jeffrey says, I use them to buy stocks that I like. Exactly. That's what I'm saying. If you like Apple at 240, if you want to own Apple at 240, let's say that you had dinner with the owner of Apple yesterday, and he told you, Bill Gates told you, I'm making all this up as I'm going along, and Bill Gates told you that Apple can't go below 240. It just can't. Cash value's 240. And you'll be like, yeah, I'm going to sell every 240 put I could. Because the worst thing that'll happen to you is you'll own Apple at 240. That's not why people are afraid. People are afraid because it carries unlimited risk. Unlimited risk. They'll send you to the poorhouse. You sell an option for $1 and then you'll have to buy it back for $100. That's not good. Okay. We're not talking about, John, I haven't said one word about spread this entire time. Don't go ahead of me. Don't go marrying somebody if you don't even know if they're a woman or a man yet. Follow along with me. I didn't say anything about spreads. My question was, why do people not like selling naked options? I stopped there. Okay. Okay. So I'm going to close the chat again. The reason is unlimited risk. You sell a put right here. The Apple here. Let me give you a real example. Look at Nvidia. It looks beautiful. Negative earnings. You sell a naked put right here because you think you're cute for $1. Nvidia opens right here. That put is now $80. You owe $79. You are in BK. Your account is gone. You lost 80 times what you risked. That's why people don't like naked puts. So, but what if you could sell a put, a naked put, and still have protection? Wouldn't that be great?
That would be pretty magical.
Wouldn't that be great? So
Yeah.
let me show you a little magic trick. Okay. Let me show you a little magic trick. Give me a good stock. I don't want to use Nvidia because it's got earnings. What stock just had earnings like 2 days ago, yesterday? What stock?
Like Merck or
Yeah, Merck. We could use Merck. Yeah, we could use Merck, I think. So let's look at the options. So let's say right now, expiring let's just do already next Friday because it's already getting close to the end of the week. So let's say we think Merck is just going to keep doing this, okay? All right. And let's say I sell the 120, about right here, 119 here. The 119 put for 68 cents. Just go with me on this one. Just go with me on this one, right? That's a naked put. Your broker will be really upset at you and he won't let you do it. You have unlimited risk because if tomorrow, if Merck drops to 100, you're down $22.68. You don't want to do that. That's suicide, right? But think about how fast, if you could, let's think about how fast this would decay. Because remember, in 9 days, this is worth zero. As long as we stay above 119. It's very interesting, right? Okay. So what if we buy ourselves a little insurance policy? Let's say we go 51 days out into the future. And what was that strike price? It was, what was that strike price? 119. And right here, 119, 120. Let's just say 120. Okay. And let's buy the 120 for $3.90. Okay. You're thinking, well, Roger, if you're trying to take premium, you're being pretty stupid about it because you're taking in 68 cents, but you're spending $3.90. What kind of a credit is that? Sounds like you're doing a debit spread. Don't fool me. I know math, and you're right. I am doing credit. Watch. So I go ahead and I buy this. Okay? Okay. So Merck keeps going, he keeps going and going, and it doesn't go down. And this 119 expires. Okay? So then the following week, I say, you know what, Raleigh, let's do it again. Let's sell another one for another, let's say it's going to be worth 70 cents. Let's say 70, $1.40, okay?
Okay.
And another week goes by, and you're like, Roger, you're not good at math. You took in $1.40. You took in $1.40, but you spend $3.90. Ha 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 ha. You don't know what the hell you're talking about. And you're right. But here's the problem. I just pocketed how much? $1.40, right?
Yep.
Well, in those 2 weeks, how much premium do you think this option lost? How much do you think it lost in 2 weeks? Probably about 40 cents, 50 cents. Okay. How much did I make on the other spread? $1.40. Now you understand? This, my hedge, loses premium at a much slower rate than the options that I'm selling. I'm selling ice. I'm buying frozen steaks. Those little pieces of ice are going to melt and melt and melt and become worth nothing. But my steak, even if I take it out of the freezer for 12 hours, it's still going to be harder than a shoe. Understand? So here's what it looks like. So let me cut all the nonsense and all the theatrics out. So here's what happens. When you find a good option, you can find an option that has 80% implied volatility to 30% implied volatility, because the option that expires in 2 months isn't even going to start decaying for another 15 days. These options are like, by the time I take the ice and I put them on the counter, they melt. So here's what it looks like. I sell an option for $1.50. I buy an option for $5. This option that I sold for $1.50, I'm debit $3.50 now. $3.50 debit in the hole, $3.50. This option that I sold for $1.50 expires. I sell another option for $1.50 and it expires too. I just gained $3 here. This option that I paid $5 for is still worth $4.10. Okay. I lost 90 cents on my hedge and I made $3 on my income. So I just made $2.10 net in 2 weeks. Those, my friends, are diagonals. Now, you may be asking yourself, Roger, but what if Merck during that 2 week period starts dropping? Well, remember, for every dollar that you lose right here on this option, you gain $1 on this option.
Mm-hmm.
You have a complete hedge. Well, what happens if Merck goes up? You make money. You just take off the spread with profit because your longer term option is going to increase faster than the option that expires tomorrow. You just take profit because this put is going to start decaying really fast if it goes up. Remember, you're selling a put. Up makes you money. That's what you want. Well, okay, Roger. So you're saying that if it goes up fast, I make money. If it doesn't go up fast, if it just stays where it does, I make money. Well, what if it goes down real slow? If it goes down real slow, you're still okay. The only way you lose is if it goes down really fast, we'll have to liquidate. I mean, excuse me. The only way you lose is if it starts going down really, really precipitously slow, and then we can roll out of it. Okay. So now that you understand what I'm trying to do, what I'm trying to do is I'm selling an option that expires in a few days, and I'm hedging it with an option that doesn't expire for 2 months. This is a hedged position. It's like a calendar spread. So your broker is only charging you the difference between what you're paying and what your debit is. Okay? Okay? And that's usually very, very little. We've seen returns on these spreads of 50 to 80% in a few days. Okay. So what is the criteria for the trade? Stock should be at least $50. It should be a large cap. It should not be an ADR. It should not be a biotech. And it should not be a highly choppy stock. We don't want any of those things. We don't want any illiquid stocks because illiquid stocks increases our spreads. Okay. We want to make sure the stock is neutral or slightly bullish. Secondarily, we want to make sure that the overall market is more or less stable. We don't want to do this the day before NVIDIA earnings comes out. We don't want a lot of gaps in the stock. We want the VIX. We don't want the VIX to be like sharply above 20. We basically just want the market to be doing what it's usually doing. Nothing crazy. That's all. Nothing crazy. And stocks, technically, we want stocks that are in a bullish flag. Those are perfect. So in other words, they go up and then they just consolidate. Like this. This is a flag right here. Right there. Okay. That are just slightly above the 8-day EMA, just like this, just like Johnson & Johnson, boring stocks like that, okay? You're not looking for high flyers. You don't want stocks where the 10-day ADX is too hot, okay? So if the ADX is above 30 and the stock is moving like that, that's too hot. You want ADX between 15 and 30, okay? So you don't want stocks that are overextended where the Bollinger Band is where the Bollinger Band is already wide. And if you don't know what I'm talking about right now, if I sound like I'm speaking Chinese when I talk about Bollinger Bands and ADX, we talk about those things all the time. Can you hook me up, Matt?
Yeah.
We talk about those things all the time. And again, we want to make sure that the stock we're looking at just had something happen to it a few days ago. Earnings, an upgrade, a downgrade, some kind of volatility. We want to spike. Thank you. We want to spike in volatility. So those options that we're selling are nice and expensive. Okay. Because without a catalyst, the spread will be much more expensive, and it'll just take you longer. You'll have to do more rolling over to make that premium. Okay. Now, how do we implement the spread? Okay. We sell an add the money put that's expiring this week or next week. If it's Thursday or Friday, we already like Wednesday afternoon, you start with next week. If it's Monday or Tuesday or beginning on Wednesday, you do this week. What is an add the money? You see how this is a 244.77? What's the closest option to it? That's add the money. So in this case, it would be 244.50. Add the money. Okay? Add the money. And you want to buy a put, your hedge, at a one strike price lower. So what's one strike price lower from 244, well, actually 242.50, it would be 240. So you'd be selling the 242.50 and you'd be buying the 240 at least 6 weeks from now. Okay. Now, Roger, we got earnings in 5 weeks. I can't buy puts that expire in 6 weeks. Yeah, you can. You're not going to be holding it for 5 weeks. You're going to be holding it for 2 weeks, 3 weeks. So if there's an earnings intervening, that's okay. Don't worry about it, as long as the earnings are not 2 weeks from now. Okay. It's best if you just had earnings already come out. So you're selling an add the money option that expires this week if you got more than a couple of days, or next week. And you're buying an option 6 weeks to 8 weeks that expires 6 to 8 weeks later. That's one strike price below the option that you're selling. You see how easy that is? Real easy. Now, your risk on the trade is the difference between your long and short put strike prices. So let's say you do one contract. This is your risk right here per contract, $2.50. That's your max risk per trade. Okay? Because if this gets exercised, remember your biggest fear? Well, you can exercise this one yourself. You press the auto exercise button at Thinkorswim and it exercises. So you go short at 242.50 and you're long at 240 and they cancel each other out and you eat $2.50 of risk minus the premium you took in. Okay. So now you understand what your risk is per trade. So I gave you the setup, add the money, one strike price out of the money for the one that you sell. The biggest question here is not set up the trade. It's how you manage the trade. And I'm going to talk to you guys about this right now. Raleigh, I have the chat closed. Are people getting value out of this?
Oh my gosh, absolutely, Roger. And there's a lot of follow-on questions here, but we'll get to that when you're done here.
All right. Now, we want the position to stay at the current price or trade slightly lower. If the price moves down, the put you sold will increase in price quickly if the stock goes down fast. The put you sold will decrease price quickly if the price goes up fast. You understand? The put you bought will increase in price slower than the put that you sold. The put you bought will decrease in price slower than the put that you sold. I'm going to repeat both of those things again for you. The put that you sold will increase in price quickly if the stock goes down fast. The put you sold will decrease in price quickly if the stock goes up fast. The put that you bought, not sold, will increase in price slower than the put that you sold. The put that you bought will decrease in price slower than the put that you sold. If the short put is exercised, you will end up with long shares, a long put, basically a hedged long position. Okay? So you're going to have a covered put. These are your strikes, and that's what your put is right there. So you're always going to be hedged. Price basically goes. So here are the scenarios. Write this down. Do yourself a favor. Write this down. Price basically goes nowhere on the underlying. You profit, mazel tov. If the stock is near the same strike price at expiration, you just keep rolling short the put to the following week, bringing in more premium, basically put on the trade again. The put you sold will decay quickly, while the put that you bought will decay slower, increasing your profits. What happens if price goes slightly lower on the stock, but doesn't break support on the stock? You still have a chance to profit. If the stock has fallen below your short strike price, but the stock is still bullish, just sell puts at the same strike as previous week. Close out the current week at a loss. It'll avoid exercise on your short. Remember, even if you're slightly in the money on your put, if the stock has premium, it will not be exercised. What if you get assigned on a stock and the stock is going down but still holding support? If the stock falls and you get assigned at your short price, then sell, liquidate the assigned long, and sell next week's option unless the stock has broken support. Then sell the stock and hold your long put if it's broke support, because then you can make money on the downside. What if the stock goes up slowly? Roll short, hold puts, profit. If a stock moves up a strike or two, sell puts at the new at the money strike price. Keep your long put. Basically, take profit on your short put that you sold and roll them over while holding on to your long position without doing so. You're just rolling one side of the spread, taking profit and rolling one side of your spread. What if a stock goes up quicker after initiating? Take profit. If a stock moves 3 strike prices, and if there are still many weeks till expiration, sell the long protective put and buy another protective put at a higher strike price to control risk. Liquidate the short and initiate a new short at the money on the new price level. What if the stock goes up slowly? If the stock goes up a strike or two, not 3, a strike or two, sell the put on at the new at the money level and keep your long put. Basically, take profit on the short put and roll them while holding onto your long position. So, what if a stock goes up a lot right after you initiate it? You take profit, silly. What do you need me for? Okay, now, let me give you a couple of real life scenarios, okay? This document, by the way, that I'm going through pretty quickly, it's in the members area of weekly cash flow, by the way. And no, I'm not going to post it here. So let me give you a couple of scenarios, okay? So let's say Bank of America. You sell the January 31st expiration 47 put, and you buy the March 21st put. Your debit is 50 cents. So you're going into this trade with a debit, not a credit. You're like, Roger, you told me this is an income strategy. What the hell's going on here? So your debit is 50 cents, okay? So you buy back the January 31st, the one that you sold put, and you sell the February 7th 47 put. You just roll. You're still long the March 21st, but the January 31st, we're going to rotate that. So you credit of 30 cents against the debit of 50 cents. So now you have a debit of only 20 cents. So now look at this. You buy back the 47 put and sell the March 21st put for a credit of 68 cents. Debit of 50, credit of 30, credit of 68. You took in a credit of 48 cents. Now, here's the part that's interesting. What was the cost of this spread, Raleigh?
Hard for me to read that. 50
50
cents?
cent debit.
Yep, there we go.
50 cent debit. How much did you make on this trade in 2 weeks? 48 cents.
48.
So if you risk 50 cents and you make 48 cents, how much money did you make in 2 weeks? 99% profit. Actually, 96% profit. Your risk is 50 cents on this trade. You came out with 48 cents. You risked 50, you made 48 cents. You almost made 100% in 2 weeks. Okay? Let's try another one. AA, Alcoa. You sell the September 5th 30-second put. It must have been at $32. And you buy the October. So I went all the way 6 weeks to October, and I went one strike price lower, and I bought the October 30th put. How did I start out the trade? Again, at a 50-cent debit. So again, you're like, Roger, you keep telling us this is a credit, and you keep taking debits. Watch. I sold back the September 5th, this one right here, put, and I roll it to the 12th. And I do it for a 60-cent credit. So now I'm already 10 cents in the positive.
Yep.
I'm already 10 cents in the positive, right? Then on September 12th, I buy back the September 12th put, right? And I sell the October 17th put for 70 cents. 70 cents credit. 70 cents credit. 50 cents debit, 70 cents credit. Sounds to me like I just made 120% on my trade. What?
Absolutely, Roger. Yeah.
How did you do that? I'm telling you, because what happens is this option right here and this option right here. See, I sold 2 options, 2 weeks. And these options, both this one expired and this one expired. Here, the September 5th option expired. The September 12th option expired, right? So I keep the premium on both of the options above, right? But Roger, you bought also the October 17th. Well, in the 2 weeks that I held the option, my October 30th put, it barely lost any value. So the premium that I took in here compared to the premium that I paid for the October option for 2 weeks, I rented this option, okay? I rented my security deposit. And now I gave my security deposit back. It paid for it, it barely lost any value. So I came out with 70 cents credit. So here, 50-cent debit, 48-cent credit. Hey, here, 50-cent debit, 70 cents credit. See that? So remember, you're selling options, and these options are decaying much faster than the option premium that you bought. Okay? Now, these trades are now, in addition to doing credit spreads and weekly cash flow, we also do these trades. So now you get a chance to have a double whammy, okay? A double whammy. Now, I'm going to give you a class, and today's the last day for this. This is weekly cash flow. And as I mentioned before, we now have these Now, I don't expect you to do these yourself. But what I do is I give you these trades. And their trades are very simple. Sell, buy. A week goes by. We either roll the one that we sold or we hold on to it. That's all we're doing. That's all we're doing. It's just 2 sides. But we're not doing them like this, vertically. We're doing them horizontally. We're taking advantage of time decay. Do you guys know how I learned this strategy? I learned it from the same guy that I learned the time spread strategy from. He's a market maker. And he was doing these strategies because individual investors would do the opposite of these strategies. And market makers are not in the business of losing money. So what you're doing is you're taking a trade this is a bookie trade. You know how a bookie trades? He takes both sides so he can't lose. This is called a bookie trade. All right. There are not a lot of folks doing these diagonals because most folks stick to credit spreads, debit spreads, but these diagonals they're the money, okay? They are the money.
Fantastic, Roger. And listen, before we get going, I need to let the people know that if you're on YouTube and you're watching this, now is the time for you to switch over to our Zoom room, because YouTube does not allow us to put any kind of a promotional event or play music or things of that nature. So what you need to do is come on over to our Zoom room, and we'll continue the rest of this presentation, where Roger's going to talk to you about an alert service that he has put together that will help you and show you exactly how to leverage spreads and diagonals in the markets. And it's fantastic. So once again, Roger, we had a lot of terrific feedback from this. And for those that were new to the concept of diagonals, yeah, when Roger goes through it, if you listen to it, you can get a little confused. But as he said, it's fairly simple. And for those of you that want to attempt this, please do that in a simulated account first. Make sure you really understand what you're doing before you actually place any real money. But once